Welcome to TheoTrade. This is Don Kaufman, May 18th, 2022. There's 9 minutes left inside of today's trading session with the S&Ps down over 4%, Nasdaq down over 5%. The markets are really beginning to feel some of that fear, some of that panic that we've discussed so readily in some of both the weekend updates and these Wednesday updates. Let's get to work in this evening's video. So the S&Ps are coming into the cash close down some 4%, but I'm going to tell you right now, we're not home yet. And I don't mean that to intimidate people. I mean, there's some signs on the screen right now that just simply they don't make tremendous sense in a marketplace that's feeling a 4% sell-off. And that is one of the key items that I really want to bring to your attention, because you think about the market's kind of feeling some panic in here, but the reality, it's only the beginning of that. And I'm going to show you exactly why as I explain that. And again, I'm not saying this to be directionally biased or to intimidate anybody out of positions. Nevertheless, there are some items in this marketplace that just simply scream out to you that more risk is likely forthcoming. Obviously, that is not per se what everyone would want to hear if you've got any degree of long positions. Nevertheless, that's the reality of this marketplace. So let's get right to work tonight and take you into, the last 7-8 minutes of this trading session. One of the first things I'd like to express is that both volume in the S&P futures throughout the course of the trading session, okay, and really as the trading session as a whole, they're light. Again, volume in the S&P futures continues to be rather light. The reason I express this is because it doesn't reek, if you will, of capitulation. As I've always used these terminology, like you want to see like fear and loathing in this marketplace. You want to feel that fear as you look at the marketplace and think it's never going to come back, that the bottom is going to drop out. And quite frankly, when you start to look at the volume inside of the S&Ps, you ask yourself, does that reek of fear? Is there loathing in the marketplace? We're going to be lucky to crest 2 million S&P contracts right now. That's the first thing I wanted to point out, because volume's just not there. The next thing I wanted to point out is throughout the course of the day, we didn't have any just wild and precipitous sell side activity. We were just kind of sliding and basking into a sea of redness in the overall marketplace. There's been no, if you will, like full court press or like blitz of sell side activity into the close. Look at this throughout the course of the day. Now, I am literally on a 1 day, 1 minute chart. And do I look at this a lot? Yeah, but I look at it specifically for volume. Look at some of the selling going on in here. Here's a move from roughly 39.50 just down to, 39.30. That's 20 handles. Okay, and I'm going to zoom into it. In 20 handles, we were not even substantiating 4,000 contracts a minute, right? That's the kind of move that you want to see. You got to do like, 8, 10,000 contracts a minute. You have to feel like there's nothing but selling, okay, ahead of you. And it has to turn into that quintessential, if you will, bidless beast. Okay. And even though the Nasdaq, and again, you're looking at the Nasdaq earlier, you got to be kidding me, Don. Okay. So the Nasdaq, yeah, in the last, 10 to 15 minutes, it's getting extreme, right? You got 5 minutes left in the trading session. You're down over 5%. There is no limit down, by the way, in the last just over half an hour of a trading session. Nevertheless, it just doesn't have that hideous feel. Now, how quantitative is that? Not very. Meaning that, when you start looking at volume in a 1 minute, you start looking at the daily volume. But I'll tell you another aspect that really resonates with me. And this is the kind of stuff that not too many people understand. If you look over here at active trader, and this happens to be specific on thinkorswim, this is just a trade ladder. Like, listen, neither here nor there. Okay, watch this. I'm going to freeze the screen really quick. And the reason I froze the screen, I don't care that there's 4 minutes left. I want you to see, okay, this bid size, okay, by the offer. Wow, this is thin. It's incredibly, incredibly thin. And what I mean by that is, like, there's only like one area that we even have, all right, one price point that we have, like, 400 contracts on the bid. The depth of marketplace is like non-existent. So what I'm basically saying is there's not a lot of market making firms, and this is the last like 3 minutes of the day. This is when liquidity should be absolutely unequivocally the deepest. So not only do we have low volume, but we have no liquidity. What that basically implies, no one's stepping in right now to make an extraordinary and deep marketplace. A deep marketplace means, hey, let's be 500 up on either side of this marketplace. I'm 500 bid by 500 offered. No, I mean, how often do you actually see this? You know, I'll freeze the screen at any given point. Look at this. There's 22, okay, on the offer by 25 on the bid. Okay, that is categorically light, incredibly light. And it should be intimidating because what it basically says, not even the market making firms want to step in here and take risk. Okay, it is on right now, people. All right. Before I go any further, I think it's also imperative to understand that the construct of the marketplace has actually changed a little bit just in the last day of trade. And when I say the construct of the marketplace, what I'm referencing is we're actually seeing a much more classical rotation right now, which is called like risk on, risk off. Okay, if you're not familiar with that term, well, today is most unequivocally a risk off kind of a day. What that basically means is everybody get out of the S&Ps and dive into products like bond. They'll buy volatility in there too, but we just haven't seen that. I mean, look at the bonds over the last, the last few months, and the bonds are in a full-fledged crash. All of a sudden, we decide, okay, we need to buy bonds. There's nothing else on the screen. Like, what else is bid in here? If you haven't looked over at the advanced decline line specific to the S&P 100, and I like the S&P 100 because I'll tell you what. Does that not speak volumes? This is what I call the quintessential full court press. There it is. It's Target, followed by Costco to the downside. By the way, Target probably single-handedly caused most of this. I mean, Costco and Target really caused a bit of a domino effect to the broader marketplace. But again, in stark contrast to any of the trade that we've seen lately, we're seeing that more classic, risk on, risk off. Today's risk off, we're piling into bonds. Does that make me feel warm and fuzzy? No, not really. Okay, but I will say this, that does bring us one step closer to, if you will, a degree of a bottom, a classical move like that. But you can see that we're buying bonds right now. For instance, we're buying some dollars still. Okay, but the dollar to me looks like an incredibly, incredibly full trade. Like I can't get excited right now. Oh, I really want to buy dollar when the dollar is absolutely exploded. I mean, where do you want to start? You want to start back here at 95, or you just want to talk about the fact that it moved from 100 straight shot up to 105? Again, currencies are absolutely out of control, if you will, at this moment in time. So again, we're seeing rotation towards the dollar. By the way, don't look for gold to save you. Why shouldn't gold save you? At this point, maybe gold is okay, but gold's not going to save you in a strong dollar. Gold's not going to save you from inflationary pressures when everybody's hopping into the dollar. It's just, that's the reality of the trade at this point. Let me give you some really alarming things on the screen. One of which, of course, you got to look at VIX. So if you haven't looked at VIX in the last couple of trading sessions, obviously you'd be missing something. Now, VIX is what I kind of call my, predecessor's volatility indicator, but I think a lot of people understand it. It's the S&P 500 volatility index. VIX has been absolutely crushed in the previous 4 trading sessions. Did the marketplace really rally that much in the previous 4 trading sessions? No, not really. I mean, we just didn't do that much. I mean, we touched all the way down to 38.55. We bid back up here to 4,100. Here we are. Once again, we could be facing some of the lows in the next, day or two of trade. Nevertheless, okay, what is going on in VIX? I'll tell you what, it does appear, as I said in the weekend update and so forth, there are structural issues in the marketplace. There is the closing bell, down about 4%, 5% decline in the Nasdaq. There are some structural issues that you'd have to look at inside of volatility. And one of the structural issues is that, okay, apparently a lot of firms alleviated themselves of hedges, okay, and alleviating themselves of those hedges have left them wide open. What I'm saying when I say alleviate of hedges, many firms bought puts. Evidently, they sold puts. How do we know that? Well, they sold puts. You would know that by the fact that volatility collapsed. They sold puts that they owned because skew happens to be, and again, I'll bring this up on a 10-year. I mean, the whole history of skew. The last print to skew here is 117. It's one of the lowest prints ever. The VVIX, which is the volatility index. Okay, bring up the VVIX. The VVIX has an incredibly low print. In fact, To look at the low print from yesterday, I bring it up on a 3-year in here, okay? It's not the lowest print, but it really is one of the lower prints that we've seen any time in the last, 2.5, almost 3 full years since we've seen a print that low. So everything points to these firms having gone out and alleviated themselves of hedges. And the warning I gave you on the weekend update is if we go down now, everybody's going to get caught with their pants down. It didn't mean that we're going to go down because they alleviated the hedges. It didn't mean that we had to go down. It just meant if we saw some sell side activity, that's it, people. No one's hedged at this point, and they're going to have to start to reach again for volatility. So the other aspect in here, and this one really resonates with me, is earlier today, we were actually in an absolute wicked contango. We actually just here into the cash close flipped over once again into a backwardation. For those of you that do not speak, okay, complete and utter geek. What Geek Fest means, okay, is that short-term volatility futures were well below some of these longer-term volatility futures. Well, that changed today. What transpired is volatility really did finally start to rage, and we saw June start to eclipse July. You need that for degrees of capitulation. Frankly, though, look at this. We're coming in, 2 minutes after the close. The market's technically still open. It's only 10 cents, okay, of backwardation. Like, I'm not going to go out and high five anybody that's capitulation. And that is precisely the point. In asking that question, are we beginning to feel some panic? Okay. Yeah, maybe a little bit. We're not home yet, though. I mean, Target woke up, all right? A lot of the world, simply in respect to the fact that, and by the way, if you're looking at Target, you got to bring this up like in a 3-year weekly. Yeah, that is huge. Or even better, you want to see a 3-year weekly? Okay, that's Walmart. The Target earnings today woke everybody up that we might have gotten this wrong. By the way, Target had about a $14 expected move. At one point today was actually down some $60. It's about 4.2, 4.3 in terms of standard deviations outside of its expected move, right? It's like mathematically insane numbers. So it wakes it up. There's a bit of a domino effect. But the interesting point over here, okay, is that yes, we went after stocks today that hadn't been hit. If you start looking at stuff like anything consumer staples related, just got annihilated. Where there looks like there's going to be some opportunity, though, take a look at stuff like utilities. Utes are still holding up really well. There might be an opportunity here in the very near term. Okay, what you want to look for in a marketplace like this is opportunity, where sell side has not necessarily transpired. But one of the things that really shocked me, and again, I think this could be another opportunity, look at the financials. The financials, did they come off today? Here, look, okay? Let's just actually bring it up on a daily chart. Did they come off today? Absolutely. But the financials, once again, they're only down about 16% on a year-to-date basis. And when you start comparing that to the S&Ps are down 18%. There could be opportunity, once again, in the financials to the downside. Last aspect that I think is absolutely critical. So we talked a little bit about, all right, some real fear is starting to emerge in the marketplace, but we're by no stretch of the imagination home. Like if you think that this is capitulation, this is not what it feels like. And I'm telling you right now, even if we rally back, I'm going to short into it. I'm not going to be high-fiving anybody. I don't care if we went all the way back up to 42.11. I didn't see, okay, fear and loathing in this marketplace. Now, overall, I ripped down a lot of my risk inside of the TheoTrade portfolio. I took stuff off profitably, left and right. Okay, we sold off a little bit. I closed a lot of the naked short calls. We actually rallied just a bit. I actually covered some of the naked short puts. I've covered a lot. I mean, I'm sitting here, okay, lo and behold, with only 80 spider beta weighted deltas of risk, collecting about $200 a day. The other day I had over $400 a day. So again, I've ripped down a lot of positions and ripped them off profitably. Okay, the last thing I want to mention in this evening's video, take a look at the SPX. I think it's critical to understand where the SPX is. Okay, the SPX was expecting about $133 move throughout the course of the entire week. Evidently, we did more than that today. So we were looking for this $133 move. Are we there yet? We're not actually there yet. In fact, one of the things I want you to understand, because everybody's asking me right now, is he selling premium into today's close? I'm not. I didn't sell any premium. I don't mind saying, look, okay, I had 8 orders, 8 fills. I closed all of our Coke positions for a 55% gain, rolled some Home Depot, closed some other risk out today. okay, and a partridge in a pear tree. I just didn't do a huge amount, but I did not sell premium. And one of the reasons I didn't sell premium is right there is the lower edge of the expected move. It's 38.91. 38.91 inside of the SPX. Until we actually hit that, hey, listen, okay, we're not home yet. And you should rationalize and realize this marketplace, even in the overnight trade, you may actually see some more volatility actually play out. Again, looking back at the S&Ps into the close, as I said, we'd be lucky to get to 2 million contracts, and 2 million contracts is precisely what we've done, okay? Hold on, people. This could be a rough end to the week. Just between now and Friday's close, which of course is May 20th, you still have an $85 anticipation of movement. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.